Hi, I'm Thomas. Welcome back to the course Financial Management. Today's topic is sources of business finance. One important concept regarding business finance is time frame. Short-term financing is financing due in 1 year or less, and long-term financing is anything due beyond 1 year, or in the case of equity, financing that doesn't have a due date. Sources of business finance in the short-term category include short-term bank loans that are due in 1 year or less, as well as working capital. The way we're using receivables, payables, and inventory all relate to the concept of working capital. And long-term financing due beyond 1 year or never. Equity doesn't have a due date. That's considered long-term financing. The use of retained earnings, the return on capital that the company doesn't pay out to its shareholders in dividends is retained for use by the company, and that will consider a long-term source of financing. Long-term bank loans, which have a maturity date beyond 1 year, as well as bonds, which are similar to bank loans but are a type of debt security, which we'll look at more closely shortly. Looking at characteristics of equity. Equity is investment by shareholders who are the owners of the firm. They have ownership in the entity. As owners, they have voting rights and control of the organization. They have the rights to residual assets. If the company liquidates, pays off all obligations, any cash left in the bank will be distributed to the shareholders based on their percentage ownership in the company. Interestingly, there is no legal obligation for a company to ever make any payment to shareholders. Now, the comment just before this point was only applicable in the case of liquidation, but it is theoretically possible for a company to operate indefinitely into the future, and there is no obligation for a company to ever give funds back to shareholders. There's no legal obligation for a company to ever pay a dividend. A company can choose to pay a dividend, and as shareholders have voting rights in the company, they have influence over that decision, but there isn't in and of itself, in the nature of equity, an obligation on the part of the organization to make any payments to shareholders. And finally, public equity. Shares in public companies can be traded on stock exchanges. So someone who has an equity investment in a public company that no longer wants to be an investor has a market on which they can sell their investment. Retained earnings. This is a form of equity that is a result of the company's operations which have generated income over time. Retained is referring to the fact that these income amounts have not been paid out in the form of dividends to shareholders. And a dividend is a distribution to shareholders, a type of return on investment. When shareholders acquire stock in a company, they're looking for some type of return, and one type of return would be a dividend. Typically, companies pay dividends if they're paying dividends on a quarterly basis. But again, there is not a legal obligation to pay a dividend. Once a company declares a dividend, they make an official decision to pay a dividend, then there is an obligation. But in and of itself, having shares, having equity in a company does not mean that the company has an obligation to pay dividends to the shareholders. Bank loans and bonds are a form of debt financing. These are classified as liabilities. Both have periodic interest payments which are due. Bank loans typically require monthly interest payments, and bonds generally require semi-annual or every 6-month interest payments. The repayment of principal, the original borrowed amount, at some point in the future is required. Loans don't give ownership rights. They don't give voting rights. They're not equity positions in the company. They're loans to the entity. There's a risk of default whenever an organization borrows money because they now have a legal obligation to repay not only current interest payments, but the principal amount at some point in the future as well. There's a risk that the company won't be able to make those payments when they're due, which would create a potential legal situation. A lender who doesn't receive payments on time can take legal action against a company. And finally, bonds can be traded on securities exchanges. Bonds in public companies, similar to the equity of public companies, can be traded on exchanges for investors who lend money to a company. They don't want to stay in that investment. They have the option to sell their investment on a securities exchange. Working capital. Working capital is a form of financing that comes from operating activities. The main components of working capital are accounts receivable, inventory, and accounts payable. Accounts payable is directly a form of financing. It's, in essence, an interest-free loan from the supplier. Accounts receivable and inventory are indirect forms of financing in the sense that when we sell goods on account, that's accounts receivable, and the sooner we collect that money, the more funds we have available for operating needs. And inventory requires cash. To the extent we can purchase our inventory on terms, that gives us some additional financial flexibility. And to the extent we keep inventory levels low, that requires less cash tied up in inventory and available for other opportunities. And operating policies are what drive working capital. Companies have policies regarding how quickly they collect receivables and how much, if at all, they sell on account to customers. They have policies regarding how much inventory they have on hand and how quickly they pay their vendors or how quickly they pay their accounts payable. So while working capital in this context is a financing concept, it's really an operating concept, but based on company policy, the treatment of and working with working capital becomes a form of financing for the organization. And finally, financing for startups, small businesses or new businesses. These kinds of companies aren't going to issue stock in the public markets. They're not going to borrow significant amounts, if anything, from banks. So what is the way to start a company who's just getting into operations? One is personal funds of the founder or founders. The people starting the company usually put in some of their own capital. Another source is friends and family, getting people that the founders have a personal relationship with to invest in the company. And finally is working capital, minimizing sales on account, minimizing inventory levels, and trying to get as favorable of terms as possible on inventory and other purchases so that the cash outlay can be made at some point in the future. This gives financing to the startup company. So all three of these sources are good options for startups who might not be able to get money from big investors or from banks. This concludes the lecture, Sources of Business Finance. Be sure to be in class when we work through our case study analysis, and you'll have the opportunity to apply these concepts in a real-world scenario. I look forward to seeing you then.